Everyone has a dream. Maybe it's to travel, to start up a new business, to retire early, or perhaps to save for a post-secondary education. Whatever it is, the secret to making that dream a reality is to find ways to make your money work harder for you as soon as you can. Planning for financial wellness is a bit like training for a big game. It needs the same sort of care, attention, and externally provided coaching from a trusted advisor who you know will always put your needs first. And just like a big game, the best place to start is by understanding the playing field. Let's take a look at the common ways to help you grow and protect your assets and how they'll fit into planning for your future dreams. In life, we're often faced with controllable and uncontrollable events. Part of a robust financial planning is to have a strategy in place to address both. That means understanding what your needs are from a savings perspective, getting on a path to hitting those savings goals, planning on how that wealth will transition to your loved ones later in life, and ensuring that you're protected from the life events that could derail your plans. Here's what happens when you come to meet with our teams. First up, we get to know you really well. We'll ask a lot of background questions to ensure that we have a full picture of your needs, your dreams, and your challenges. Next, we'll work with all the data and information you provide us with to really analyze your situation and put together a framework of recommendations to help get you set up to achieve your dreams. We'll present and review all the recommendations with you, ensuring that you have a full understanding of the options and what they mean. Once we have a plan, we work to implement these strategies together, and finally we agree on a monitoring and review program that works for you. Whether you're a hands-on or hands-off investor, we have a scalable model that can accommodate everyone. There's a lot of different ways to invest. When you're reviewing financial planning solutions that you're presented with, here are some of the account types. An RESP is a registered education savings plan. It is sponsored by the Canadian government and that encourages investing in a child's future post-secondary education. Subscribers to an RESP can make contributions that grow tax sheltered. The account can hold investments, much like an RRSP, such as term deposits and mutual funds. The government contributes a certain amount to plans for the children under age 18 through the Canada Education Savings Grant, in that a minimum of 20% grant can be provided up to a $2,500 contribution annually per child. Additional bonds and grants are also available, and some provinces also provide education savings grants based on household income and contributions. Contributions are made by the subscriber, typically the parent or others, on behalf of the beneficiary or child. Once the child is in a post-secondary education institution, he or she will receive educational assistance payments, or EAPs. Except for family plans generally, there are no restrictions on who could be the original subscriber under an RESP. TFSA stands for a tax-free savings account. Just like an RRSP, there could be various investments held in a TFSA, such as a term deposit and mutual funds are some examples. Also, like an RRSP, investments are tax sheltered. The main differences between an RRSP and a TFSA are contributions into a TFSA are not tax deductible. Withdrawals are not considered taxable income. Annual TFSA contributions have changed since they were first introduced in 2009, but currently the annual limit is $5,500 plus unused room from previous years. TFSAs are available to individuals aged 18 and older with a valid social insurance number. A TFSA can be used for any purpose and is a great mechanism for savings for financial goals other than retirement. RRSP stands for Registered Retirement Savings Plan. An RRSP can contain various types of investments, such as term deposits and mutual funds. Your contribution limit is 80% of your previous year's income, plus any carried forward RRSP amounts left over from previous years. RRSPs have two main tax advantages. First, contributors deduct contributions against their income. For example, if a contributor's tax rate is 30%, every $1,000 he or she invests in an RRSP will save that person $300 in taxes that year. Second, the growth of an RRSP investments is tax sheltered. Unlike with non-RRSP investments, returns are sheltered from any capital gains tax, dividends tax, or income tax. This means that your investments under RSPs compound at a pre-tax rate. However, all withdrawals from an RSP are treated as taxable income regardless of when the money is withdrawn. In effect, RRSP contributors delay the payment of taxes until retirement, when their marginal tax rate is typically lower than during their working years. The Government of Canada has provided this tax deferral to Canadians to encourage retirement savings, which will help the population to rely less on the Canadian pension plan to fund their retirement. A non-registered account is a type of savings account that allows Canadians to save money for the long term. Non-registered accounts, unlike RSPs, can be mutual funds and other vehicles, only tax the capital gains realized inside the account at 50% of the account holder's top marginal tax rate. And unlike RRSPs, non-registered accounts have no contribution limits. Many financial advisors recommend using non-registered accounts in conjunction with RRSPs. This allows the investors to invest in tax savings generated by the RSP into the non-registered account. Eventually, investors need to withdraw money from their RSPs. Although it can be done sooner, but by at least age 71, you need to convert your RSPs into a RIF, which is short for a Registered Retirement Income Fund. Just like an RSP, a RIF can also hold various types of investments, such as term deposits or mutual funds. The only main difference is that once the RIF has established, a mandatory amount must be withdrawn annually based on your age. RIF withdrawals are considered income and are taxed as such by the Canada Revenue Agency in the year that the withdrawal is made. A RIF plan is designed to provide people with regular income flow through retirement from the savings in their RSPs. Funds that remain in a RIF after annual withdrawals continue to grow tax sheltered, just like an RSP. This is protection against financial loss that would result from the premature death of an insured. The named beneficiary receives the proceeds and is thereby safeguarded from the financial impact of the death of the insured. The death benefit is paid by the life insurer in consideration for the premium payments by the insured and is done so tax-free in Canada to the beneficiary. The goal of the life insurance is to provide a measure of financial security for your family after you die. So before purchasing a life insurance policy, consider your financial situation and the standard of living you want to maintain for your dependents or your survivors. Life insurance is a contract between an individual and an insurable interest in a life insurance company to transfer the financial risk of a premature death to the insurer in exchange for a specified amount of the premium. The three main components of the life insurance contract are a death benefit, a premium payment, and in the case of permanent life insurance, a cash value account. The death benefit is an amount of money the insured beneficiaries will receive from the insurer upon the death of the insured. Although the death benefit amount is determined by the insurer must determine whether there is an insurable interest and whether the insurer can qualify for the coverage based on its underwriting requirements. Using actuarial-based statistics, the insurer determines the amount of premium it needs to cover mortality costs. Factors such as the insured's age, personal and family medical history, and lifestyle are the main risk determinants. As long as the insured pays the premium as agreed, the insurer remains obligated to pay the death benefits. For term policies, the premium amount includes the cost of the insurance. For permanent policies, the premium amount includes the cost of the insurance plus an amount that is deposited to a cash value account. Permanent life insurance includes a cash value component which serves two purposes. It is a savings account that allows the insured to accumulate capital that can become a living benefit. The capital accumulates on a tax-deferred basis and can be used for any purpose while the insured is alive. It's also used by the insurer to mitigate its risk. As the cash value accumulates, the amount the insurer is at risk for, the entire death benefit, decreases, which is how it is able to charge a fixed level premium. Critical illness insurance is designed to alleviate your financial concerns should you find yourself facing life-threatening health problems. It's no cure-all, but if you fall prey to a covered condition, at least you'll be able to focus your attention on getting well, rather than on making ends meet. Critical illness insurance provides a lump sum payment to the policyholder after a claim is approved. Such policies cover a host of diseases, including stroke, heart attack, cancer, coronary bypass, and a variety of other known diseases. Some policies cover more than 100 conditions. Disability insurance helps protect members' income if they become disabled and can't work. Whether your member needs to secure their main source of income or supplement the coverage they receive from their employer or an association, insurance companies can help by providing a comprehensive and portable plan that they can rely on throughout their working years. And specialty business protection solutions are also available for small business owners. A disability portfolio includes products and solutions for full-time, part-time, home-based workers, professional students, graduates, even non-working Canadians. An individual disability plan can help your members financially so they can concentrate on recovering and returning to an active life. Long-term care coverage that provides nursing home care, home health care, personal or adult care. Long-term care is usually very expensive, which is why most people need insurance. For example, on average, nursing facilities provide skilled care charges $100 to $300 per day, more than $80,000 a year or more. Even custodial home care at 3 visits per week can cost more than $9,000 a year. Most long-term care insurance policies will cover only a specific dollar amount for each day you spend in a nursing facility for each home care visit. Thus, when considering a long-term care insurance policy, read the policies carefully and compare the benefits to determine which policy will best meet your needs. Hybrid life insurance is a life insurance policy that has disability insurance and critical illness insurance all rolled into one easy-to-manage, affordable solution. This unique design offers your members protection against life's everyday risks of disability, critical illness, and early death. Over the past couple of weeks, I've met with several members for Chinook Wealth Management, whether those members are students, young families, farm owners, basically to start really having the conversation about savings, looking into the different types of vehicles that are out there, whether that's RSPs or TFSAs. It's becoming more important, definitely more relevant as we sort of move on and going into the future, just to show them the importance that savings is really their responsibility. The other thing too is even just to talk about the education for their children, about the savings element of an RESP, getting them to know that there is free money available to them with their contributions. The government do make provisions for grants and bonds on those RESPs, and they should really take advantage of that. Prior to my grandfather's death, one of the things that I remember from a child is that his advisor had mentioned to him that he had several dollars in RSPs that he needed to do something with, meaning that he either needed to start a withdrawal or figure out a way to shelter those RSPs in case he died. The reason for that is because my grandmother predeceased my grandfather, meaning there wasn't really a sheltered way for him to move those RSPs. The proceeds were going to my mother and to my uncle, and because they weren't a spouse, that was now going to become a taxable event. So one of the things that I remember the advisor mentioning was that my grandfather either needed to withdraw some of those proceeds or effectively purchase some life insurance so that at the time that those RSPs needed to be cashed, that the significant tax bill that went along with that could have been protected, so that instead of my mother and my uncle having to pay a $300,000 tax bill, the life insurance could have been used to pay that tax bill instead.